Joining us live from the trading floor at the Chicago Board of Trade here in Chicago. He's here to help us take a closer look, I should say, at the reaction we're seeing to this economic data. Paul, welcome to the show. Thanks for taking time to be with us this morning. Really appreciate it, especially on a busy day like this. Let's get right into the numbers, though, and your reaction to them. For the most part, I mean, this is a fairly good number across the board. I mean, we were looking for a bit of a revision to the upside. We didn't want to see anything below expectations in terms of that non-farm payrolls data. I mean, 196,000, the bulls are going to like this one.
No, they are, and it's right in line. You know, my bet prior to the number was that we were going to be under that 175. And this, the 196 plus the revision higher, puts us right in line with the average over the last 3 months, going back a couple of years. So a 3-month average has been in the 195 to 210 range, and we're right there. The market's popped a little bit. We saw a little bit of a rally in the dollar. We saw yields pick up here a little bit. So now the big question is this strong enough to get the Fed back into it? We're hearing rumblings from some of the Fed governors that, you know, hey, don't be so quick to be putting a rate cut on the possibilities for 2020. We're not there yet. And I think this bolsters that argument at least a little bit, that the Fed could be back in play maybe later this year, if indeed the first quarter is the weak quarter out of the year.
Paul, I'm going to let you answer that question if this is the number that the Fed needed to get back on track. I mean, if you take a look at it, we've got treasuries which have come off a little bit. I want to point out that the rates are to the upside. We've got the 10-year up to 2.54 this morning. It's 2.52 right now, but I'd imagine one data point does not a trend make necessarily, and this wasn't so hot to get the Fed necessarily moving too quickly, especially with that wage number, which continues to point towards, well, no real major inflation concerns there at least.
No, that's true. And the wage number, you know, we've been looking at a 2 to 4% range historically for wage growth. You get up around that 4%, you really start to see inflation pressures pick up. This backs it off a little bit, 3.4, not too bad. And you're right, the first quarter data points for all of the economy in the U.S. and as well as around the world have been pretty weak. So I think this one is a good start to second quarter, and we're going to be looking for other data points that are going to confirm a pickup at least in the economy from the first quarter. And we get into earnings season here starting next week. A lot of earnings numbers coming out, banking to start. We'll be wanting to listen to the CEOs chatter about what they're seeing in the economy as well. So we've got a lot of stuff to be looking at here the next couple weeks as far as the overall trend for the economy as well as corporate America.
You know, Paul, I'm glad you brought next week into the discussion, because I think with a number like this, we sometimes get tunnel vision. We get our sort of blinders on. We forget about the fact that we've got a big week headed our way next week. Not only did you mention earnings starting to come back around, but I noticed we have the FOMC minutes. It's going to start off with factory orders. We got some more jobs data, JOLTS, and also CPI next week. I mean, PPI as well, I noticed. These are some big numbers. These are numbers that we should be dialed in on. Again, with a Fed that's data dependent, it's not just non-farm payrolls. All of this plays.
No, that's true. And usually, you know, when you get into the first 2 weeks of the quarter, that's really when you get the big data dump. And as I mentioned before, we're hearing from some of the Fed governors, you know, hey, don't be so quick to pencil in a rate cut. So I think they're trying to talk the markets up here a little bit. The fact that markets have rallied on the expectation the Fed is out of the picture all of this year and certainly into next. And I think the Fed, some of the Fed governors at least, are starting to walk that back a little bit. So again, the equity markets need to be walking that fine line between the Goldilocks, not too hot, not too cold, and keep the Fed on the sidelines. Again, you're right. This is one data point. We'll be looking for confirmation over the next couple months to see if this is actually the low point in the first quarter.
Paul, let's talk a little bit about some of the currency products and price activity we've seen there. You probably know where I'm headed first. I want to talk Brexit and some of the recent developments with negotiations between Theresa May. It's this week. We actually heard that she's starting to work with Jeremy Corbyn. It seems like that was something they should have done years ago, but at the very least, some progress right now. But it's interesting because, for the most part, the pound's kind of, well, callous. We were talking about it earlier in the show, to some of the ups and downs, the risk on, risk off associated with Brexit.
No, that's true, and you've seen the pound pick up here a little bit over the last few weeks. Again, Brexit is such a mess. It's very similar to the trade talks between the U.S. and China. We're close to a deal. We're not close to a deal. We're working. It's imminent. It's not imminent. And we're not quite sure what that Brexit deal is going to look like. No matter what the deal is, we're not going to see the implications and the ramifications of that deal for probably another 2 to 3 years. So even if they pencil one in today, same way with China and trade in the U.S., one gets inked tomorrow. We're not going to see the impact of that into the economy and some of the ramifications and changes a lot of the companies make for probably a couple of years yet.
Paul, do you think with all the optimism that we've seen headed into trade talks, the Brexit expectations that they're going to push it back, but more specifically the U.S.-China trade deal, I've been wondering if we're actually setting up for a situation where, as you just mentioned, it may be a couple years before we actually benefit from some of the negotiations and the moves that we were able to get China to take. I mean, are we possibly setting up for a situation where we're kind of like a buy the rumor, sell the fact type situation?
No, that's true. I would anticipate, we see the markets rally a little bit every time that the trade talks are close, get dangled in front of the market. And I think we probably get a 3 to 5% pop. After that,
you think
you're
we'd
right.
be able to sustain
just
it?
Look at I don't think so, because again, look at what's happened in NAFTA. We've already, we haven't rolled back any of the tariffs on Canada. We still have some issues with Mexico. We're talking about keeping tariffs on with China. So again, just a lot of moving parts here. And the most recent rumor is, a lot of this stuff isn't going to be taking place until 2025. So it's a mess at this point, and trying to figure out what the implications are is going to be very, very difficult.
Paul, last question, then I'm going to let you get out of here. I'm looking at these rates and that sharp move lower that we saw recently. We've come off the recent lows, but I'm curious, do you think this is more of a correction, or have we seen the bottom for the year and we can now start to work our way back into the middle of the range that we saw from the, last fall down into the recent lows that we just saw?
Yeah, I think interest rates are probably destined to go a little bit higher, but I wouldn't say significantly so. Again, I'm going to be Chair Powell. I'm going to allow the data points to kind of direct that. We're seeing a little bit of strength out of China, which has been good for the global economy. But I would anticipate rates to stay pretty quiet for probably another month or two before we start to see the data hopefully pick up and a little bit stronger, and that'll give some support to interest rates, and we could see them pick back up again higher in the months ahead.
Well, Paul, you're in good company with that thought process. Many of our guests on the show here agree with that and feel like we, again, have to just kind of keep a close eye on the data. It's tough to predict at this point which way, one way or the other. Traders, that's Paul Nolte. Paul, really appreciate you joining us here this morning. Paul is the Senior Vice President and Portfolio Manager at Kingsview Asset Management. Paul, have a great weekend, and thanks for giving us part of your morning here. Traders, that was a great look at some of the most immediate market reaction that we saw to the jobs data.